Hey guys, I hope you guys are trading well here, and you're all paper trading. I hope you've all paper traded before you started actually allocating real money to trades. I have a very special presentation today. Basically, there are 4 risks to this type of business, and I'm going to share all 4 risks with you today. These risks are something that you really need to keep an eye on as you develop your business. They're not something that are terribly intuitive, but these are the things I've learned while doing this business and by creating these business opportunities. When creating a business, an investment business, we manage, remember, by the numbers. The numbers are everything. Now, every business understands what their product is. You have to have a very good, firm foundation of understanding what your product is. In this business, your product is calls and puts. Okay, this is the stuff that we deal with, the product that we deal with. We're selling options and we are buying options. We are a business that buys and sells. Anytime you're in business, you have risks. The 4 risks that I'm going to talk about today is concentration of risk, overlapping trades, allocation of capital, and finally overtrading or over adjusting positions. Let's take the first one, concentration of risk. What I mean by concentration of risk is that you have almost all of your profit potential centered around a single strike price. For example, I have currently on the screen our portfolio with the symbol IWM, so it's weighted against the IWM. As you can see, we have a fairly wide range in which the IWM can move, and we could still profit from this position. Concentration of risks means that, let's say at the 73 strike price, you have a very large position at the 73 strike price. And I guess size all depends on the capital that you've allocated for this business. But let's say $5,000 is a lot of money to you. Well, if you have $4,000 of your money tied up in margin and they're all centered around the 73 strike price, if you have all of your risk concentrated around the 73 strike price, what you're doing is you're concentrating your risk at that point. So that if prices move way down or they move way up, you're probably not going to have the same type of profit potential as if you had a wider range in which you could profit from. So that's concentration of risk. Concentration of risk means having a lot of contracts or size position for you, and that could be, if your capital allocation for this business is $5,000 or $20,000 or $50,000 or $100,000 or $500,000, it doesn't matter. If you have a large position that you would consider large, at a single strike price, you have concentration of risk, and that's very dangerous. Prices can move dramatically against you very, very quickly. And if you have a concentration of risk at a particular strike price, you're going to get hurt. The third thing I want to warn you about, and the third risk of really this type of business, is the allocation of capital. Allocation of capital means that you have so much capital available to you. Even if you had $200,000, you don't want to spend $230,000 on opening these positions. If you have $20,000, you do not want to use all $20,000 opening these types of positions. If you have $5,000, you do not want to use all $5,000 opening these types of positions. The reason for that is just like any other business. Any other business, if they had an opportunity to buy stock, let's say they had a gift store, if they had an opportunity to buy stock to put in their store at a very, very low cost, But this opportunity is only available just for a few days because there are other people who are interested in this stock. But you could get it very, very cheaply, maybe 50% cheaper than you could normally buy it. You would need the capital available to make that purchase as the opportunity became available. So that's what we need to think about in this business. When our prices start to run up towards our break-even points in our portfolio, we need to make changes to our business to take advantage of those opportunities, because many times a position that runs up against our break-even points is an opportunity to add to our current positions. It's a smart allocation of capital. We start our portfolio out on some basic positions, but we always make sure that we have capital available. Working capital in any business is extremely important. We have the working capital to take advantage as necessary. For the fourth risk that I want to talk about is overtrading or over-adjusting. If we take a look at a current chart of the Dow Jones Industrial Average, you'll see that yesterday we had an extremely large run up in prices. In fact, they were up almost $200 yesterday. Today they were up another $115, but now they've backed down quite a bit. In fact, they backed down to the point where it's below this 200-day moving average, which we had kind of determined to be somewhat of a resistance point, as well as the 13,100 level. Technical analysis is fairly simple. You have support and resistance points. You have support, you have resistance. You have resistance, and you have support. That's pretty much all you need to know as far as technical analysis goes for the type of business that we run. That's pretty much it. But prices do tend to fluctuate. Sometimes they go up, sometimes they go sideways, sometimes they go down. Adjusting positions becomes really an art of knowing when exactly to make those adjustments. You want to try to keep your profit picture and your price pretty much centered. And if it goes off, maybe you want to do a little adjustment. You don't have to do a large adjustment. So those are the four risks of this business, and I think it's important that you understand those risks. I've talked about concentration of risk and allocation of capital, overlapping trades, and overtrading or over-adjusting. But the key point is they're only necessary because of price risk. Price risk means that the price is going to move up and down against you. If there was no price risk, you would have absolutely no problem with concentration of risk. You'd have absolutely no problem with overlapping trades. You would have, because you would not adjust anything. You would have no problem with allocation of capital because you could simply put your positions on at one price and remain there until expiration. And you'd have no risk of overtrading or over-adjusting. So all four of the risks in this business really have to do with price. Prices will fluctuate sometimes wildly, sometimes moderately, but they always fluctuate. They never stand still. So if it wasn't for price risk, none of these other four risks would even be a consideration. And those are the four primary risks of this business. All of them are easily managed. Our diamond position, we still have our one door position on. We didn't make any adjustments to the diamonds. If we take a look at our SPY position, we had to do one adjustment, which was there's really an art and a science. The science is the numbers. The art is knowing when to adjust.